Welcome to Factful Finance, where we break down complex financial topics into clear, actionable insights. If you've been following the financial news lately, you've probably heard the term LIBOR tossed around a lot. But how will recent changes to LIBOR affect your adjustable rate mortgage, or ARM? Let's dive into that and break it down for you. First, a surprising fact. Did you know that millions of Americans still have adjustable rate mortgages tied to LIBOR? But now, with LIBOR being phased out and replaced with a new benchmark, the impact could be significant. Whether you're planning to refinance, buy a home, or just trying to understand how these changes might affect you, it's essential to know how this shift will affect your mortgage payments. Before we get into the specifics, a quick disclaimer. The information here is for educational purposes only. Always consult a professional for advice tailored to your individual financial situation. Now, let's talk about what LIBOR is and why its changes matter. LIBOR, or the London Interbank Offered Rate, has been a major global benchmark for interest rates on loans, including adjustable rate mortgages. In simple terms, it's the rate at which banks lend to each other, and in the past, ARMs were often tied to this rate. However, due to scandals and a loss of reliability, the financial industry is transitioning away from LIBOR. In its place, most loans are now shifting to SOFR, or the Secured Overnight Financing Rate. This shift is designed to provide a more stable and transparent reference rate. However, there's a catch. SOFR tends to be lower and less volatile than LIBOR, which could impact your mortgage rate. Here's how that might play out in real life. Imagine you have an ARM that adjusts every year. If your mortgage is tied to LIBOR, and you've been used to seeing a small fluctuation in your rates, you might notice a difference once SOFR takes over. SOFR's lower, more predictable rate could mean lower interest rates in the short term, but it could also lead to less room for rate adjustments, especially when inflation and market conditions change. So while you may see a slight decrease now, long-term adjustments might be different. Let's look at an example. Take David, a homeowner with a $300,000 mortgage at a 3% interest rate. His mortgage is tied to LIBOR, which currently sits at about 0.2%. With SOFR replacing LIBOR, his new rate might be a bit lower at first, but that could change depending on the broader economy. If rates go up in the future, he might see a bigger adjustment than he's used to, despite the current shift to SOFR. Now let's talk about how you can prepare. If you have an ARM, it's a good time to evaluate whether it's the right loan for you moving forward. If you're considering refinancing, you might want to consult with a financial advisor who can help you assess the impact of these changes. Experts recommend that homeowners with ARMs review their loan terms carefully. Pay attention to the spread between the index rate, now SOFR, and the margin added by your lender. Even if the change seems minor, it could have a significant effect on your monthly payments over time. Another thing to consider is whether you should lock in a fixed-rate mortgage. If you're concerned about future rate hikes, or if you plan to stay in your home for the long term, a fixed-rate mortgage might offer more stability. We've covered a lot of ground today, but here's the key takeaway. The switch from LIBOR to SOFR is a big deal for those with adjustable rate mortgages. While the initial shift might bring lower rates, the long-term impact could vary depending on market conditions. Staying informed and prepared is your best strategy for navigating these changes. So what's the first step you'll take to understand how LIBOR changes affect your mortgage? Let us know in the comments below. Thanks for watching Factful Finance. If you found this information helpful, consider liking this video and subscribing to our channel. That way, you won't miss out on the latest insights that could help you manage your finances more effectively. We think you'll find the next video on screen particularly useful in achieving your financial goals.